When we think of the stock market, we picture flashing tickers, fast trades, and headlines about who's up and who's down. But have you ever stopped to wonder what a stock exchange actually does or how it's changed over the years? We're going to take a closer look at the world of the stock exchanges, how they've evolved from exclusive clubs for members into major public companies that sit at the heart of the global economy. I'm now joined by Brendan Caldwell, director at Caldwell Securities Limited, to unpack this further. Brendan, thank you so much for the time today.
Teresa is my favorite subject in business. Let's do it.
Now, Caldwell and its entities have a history of investing in stock exchanges around the world. Caldwell purchased their first membership in the 1980s. Could you tell us what proposed stock exchanges have and how they evolved from a membership to publicly traded entities?
Well, it's an interesting one. We wouldn't have considered the seat we bought on the Toronto Stock Exchange in 1980 as being an investment. It was more like a license or membership, as you say, to to trade on a stock exchange, to facilitate the trading of clients on a stock exchange. You either had to own a membership or lease a membership or a seat from another member. So when my father, our founder, uh, bought his first seat on the Toronto Stock Exchange for a few tens of thousands of dollars, it was like buying a right to access. Exchanges in and of themselves were never seen as profit centers, um, but were really seen as a way for members to make money in their businesses. This began to change in the late 90s around the world, where because exchanges had been, generally speaking, not for profits. And not for profits, well, as well as tending not to make a profit, also don't tend to reinvest in their business the same way that for-profit corporations do. So exchanges were beginning to the established exchanges were beginning to lag the technology that was out there, and new up and comers were beginning to, how does one say, eat their lunch. So exchanges both in North America and around the world started to make the transition, and there was a lot of opposition, including from us. We valued being a member of the Toronto Stock Exchange. Till we realized how much money we could make if the seat, our membership, became shares, and those shares became public. And as it turns out, we actually wildly underestimated both the effect on the industry as a whole and how much money we could make.
Now, people have compared stock exchanges to casinos. Is this a fair comparison, and what's the difference?
I would say exchanges are much more like ballot boxes. In fact, I would say that even more than elections, exchanges are the most profoundly democratic institutions the world has ever come up with, because they allow for the free expression of capital. They allow people, investors, to vote with their money. And an exchange is a place where, if you have a good business idea, you can get people to vote, investors to vote on your idea, and participate in the growth of your company. So when a company does an initial public offering or becomes publicly listed, it gives the whole world, and particularly the country in which the company is based, the opportunity to invest in that. So if you end up having a unicorn, having a multi-billion-dollar company as an entrepreneur, but everybody in your country at least had the opportunity to participate, it's a recipe for much greater social cohesion. And you say, well, isn't that how it works everywhere? No, it's not, actually. In many parts of the world, the largest businesses are not public. Not everybody has a chance to own them. The largest businesses in many countries are actually um, privately held. So a best gauge of whether a country has a functional stock exchange is whether the market capitalization, the size of the companies listed on the exchange, is actually bigger than the local economy, bigger than the GDP. So if the market cap of the companies listed is bigger than the economy, you probably have a functional stock exchange. You do in America, Canada, and many places around the world. What's been interesting to see in particularly the developing countries is how what we take for granted, that is, stock exchanges allow for a middle class. They allow for the creation of wealth. Well, we're seeing in developing countries like India, with stock exchanges going from private to public, being able to be owned and by the public, more and more companies are listing. There's a bigger and bigger part of, say, the Indian economy is becoming publicly listed, which is allowing for creation of a tremendously powerful middle class.
And how does a hot Canadian company get listed on an exchange? And should they list on a Canadian exchange or an American exchange?
Well, it would be better for Canada the more that Canadian companies are listed here. There's really there's two or three alternatives. The two that I know the best are the Toronto Stock Exchange, which is well known, and most of the senior companies in Canada are listed there. There are a couple of other options, though. The Chicago Board Option Exchange has a venue, and also there's the exchange of which the company that we control, Urbana, has a large investment, the Canadian Securities Exchange, which lists a considerable amount of entrepreneur-led companies in crypto, in cannabis, in mining, and it you need to have a certain number of investors. You need to have a certain amount of capital. You need to have a business plan, and you need to be operable. Different exchanges have different standards, different ways of going about it. What I like about the way the Canadian Securities Exchange, the CSE, does it is we've tried to make it as streamlined as possible. And I think that's important for Canada because we do not have the same vibrant venture capital market America does. Now, as a reality, Canadian companies, particularly tech companies, do like to see themselves listed on NASDAQ because there is a network effect with exchanges, as you well know from the internet, that eyeballs beget eyeballs, and so trades beget trades. The more volume that an exchange does, the more volume they're likely to do, and the more attractive they are for companies wanting to be listed there. Because companies do derive a certain degree of prestige from the exchange in which they are listed, and so too do the exchanges derive prestige from the companies that are listed there. So there is a back and forth where exchanges and the companies listed create this symbiotic relationship, which develops the network effect.
And how does an exchange make their money?
Really, three ways. Listing fees. So if you're a public company, you pay a fee to be listed on the exchange. That's reasonable enough. But the exchanges also make a little bit on every trade that gets done. You don't have to charge very much. If you're trading billions or trillions of dollars every day, you don't have to charge very much to make a good living on that. But the third way, which maybe people don't think about so much, is data and other sorts of proprietary media. So two things, like all the trades that happen, that's worth something. So whether it's on your Bloomberg screen or your Reuters screen, those entities pay for that data. And then if you create a product like the CBOE, the Chicago Board Option Exchange, created both the S&P 500 options and the VIX, the Volatility Index options. So those products, when they trade, they can charge a much higher margin on those and then license them out to other entities like futures markets. So data, listings fees, and trading fees are the three big ways they make their money.
And how are indexes created?
Well, an index is a measure of it can be an asset class or it can be a nation's economy. The reason I like exchanges better than indices as a proxy for a country's growth is that indexes tend to be heavily weighted in what already worked. So if technology or mining or financial services was the sector that already worked, the index is going to be heavily weighted in that, whereas an exchange is much more front-loaded to whatever's coming next. It's part of the reason I think that the price performance of stock exchange shares, now that they're public over the last 20 years, has actually outperformed the indices of the underlying country. And if you take all the exchanges in the world together, they actually lower the risk compared to most other global investment strategies because countries have their own specialities.
Well, Brendan, thank you so much for the time. We appreciate it.
Thank you, Theresa.